discussion of winners and losers in the U.S. China trade war. I'm joined by Kevin O'Mara, Chief Research Officer and co-founder of 0100. Hi, Kevin.
Good to see you, Bob. Pleasure
Thanks
to be
so
here.
much for being with me today. I really appreciate it. Kevin, how do you see this escalating trade tension, trade war between the U.S. and China? How do you see that affecting global supply chains?
It's building out something we've been doing for a decade, if not more, which is diversifying away from China sourcing. So I think it's kind of an accelerator to a move that most global supply chain leaders already knew was underway, which is I've got to de-risk. And so sort of the move to Vietnam, which is old. I mean, Samsung told me that sort of under the, cone of silence 15 years ago, they were beginning to move out. A lot of people have been doing that, but I think it's actually really good. I think it gets hairy when it starts to be strictly political and we're bomb throwing. But from a supply chain perspective, supply chain leaders are ready for this and have been planning for it for a long time. The short-term sort of volatility of the discussion, which I think creates uncertainty, is a negative. The long-term trend is positive, which is regionalizing supply chains, less, traveling around the world, and more producing closer to customer and sourcing from, basic geographic catchment base.
Certainly squares with companies' attempts to become more resilient by spreading around the sourcing. And of course, as you're mentioning, factory wages in China were already going up, making it economically untenable anymore to continue there. So, and then along comes the trade war and it further accelerates it. Okay, but paradoxically though, I wonder if there are some companies who are actually benefiting from the resulting overcapacity in Chinese production. Is that in fact the case? What's going on there?
China has incredible capacity. So let's just back up a sec. The capacity in China for, call it tier 3 and even below, raw materials, fabrics, chemicals, metals, is enormous. And being constrained with their ability to ship that then through tier 2, 1, all the way to the end customer, they're basically going to be they're exporting deflation. They're going to be producing volumes. They're going to find their way through these third-party countries and still give anybody who can source through that channel, I think, some significant cost advantages. Extra capacity, they got to move the product. I think there'll be opportunities for certain specialty things, fabrics, materials, metals in some cases, not the protected ones like, rare earths. But you're going to have some cost advantage. You're going to have to go through another country. And of course, you've got to watch out because Washington's intent to kind of have this trade war means they're going to be looking for that, tier N gateway country. But there are some potential opportunities to save some serious money from suppliers who have that capacity.
Well, we're certainly not counting China out as a force in global supply chains, either producing within China or the interest that China has of producing in other countries, supposedly to get around the tariffs and trade sanctions and the like, but they're continue to be a major player.
They're a major player for sure. And I mean, if you look at their export trade volumes, their largest receiving region is Asia, not America, not Europe. And that's in some cases for finished goods, in other cases for intermediate goods. And Vietnam is one of the prime recipients. But there are partners of China from an economic standpoint who are going to get some serious cost advantages and be able to pass those on to other buyers.
Let's talk about the T word, tariffs. To what degree are tariffs influencing decisions to localize or regionalize supply chains? Where do they fit into the picture?
Tariffs are sort of the, smoke alarm in the house that says there's a fire, there's a fire. It's a public expression of an intent to force regionalization, localization of supply chains. As I said a minute ago, people have been doing this for a long time. We hosted a conference at the old AMR Research. I know you know that. In 2008, which we called Globalization Comes Home. We had the former president of Mexico, Vicente Fox, as our keynote, and it was all about Cisco, who was initially decamping from China, along with a handful of others who had started to do that. So they're moving already. But the the thing about tariffs is now it is no longer a supply chain centric way of thinking about regionalizing and localizing supply chains. It's a business level, it's a CNBC level conversation. And so you have, CEO and investor support regionalizing supply chains, which you need because you're going to pay higher wages and you're going to have to do a massive capital scale up in, let's say, North America.
Yeah.
So I think it accelerates something. The smoke alarm has gone off and it's time to get out of the house.
But it's not so easy as to say, we've got tariffs on goods coming from China, we'll move our production elsewhere in the world, if indeed it turns out that tariffs are going to be applied across the board with just about every U.S. trading partner. The only alternative would be to come to the United States, which isn't always feasible.
It's true.
So what do you do?
It's not always feasible. But the nice thing is you don't do anything you haven't already done. I had this conversation with Luciano Sieber, who leads supply chains, CSCO for Colgate-Palmolive. And he said the simple, obvious thing. It's still the same equation. Lowest landed cost wins. If I have to pay the tariff and it's still lower cost to go than, to source from a new country, I'll do it. Once the tariff tips, I'm going to start looking for another source. We've been doing this in supply chain for, generations, really. So I think what happens is you can't move on a dime. Developing suppliers, certainly if you're going to build your own, if you're actually going to scale up production capabilities. New Balance is doing this in North America. They're scaling intentionally manufacturing in North America in a high-cost environment specifically so that they can be de-risked and made USA. It takes a long time, but at the end of the day, you're still really chasing the same question. What's my lowest total landed cost to get product to where I want it to be, whether it's finished goods or intermediary? So the tariffs are just sort of bumping up a bunch of extra gates that add to that cost, but the fundamental formula is really not any different. So regionalization will continue apace, in my view. And in the process, what you'll get is an easier financial justification of new capital equipment, new automation. We'll see a big scale up of robotics in high-cost countries like the United States. And shorter supply chains. You're going to find new sources of raw materials to make that possible.
But zooming out, do you think we might be at the beginning of a new megatrend that is an age of a new industrial policy, of nationalist strategies that influence production? Is that possible that we're moving into a whole new era here now?
We are. Yeah, absolutely. I mean, we've written about this. You can find specific articles by me on our website about, industrial policy is the new normal. Right? Thing is, industrial policy has been going on for a long time. Europe is full of industrial policy, all sorts of tariffs protecting all sorts of chosen industries. And China's entire story is based on industrial policy. From the moment they joined the WTO, the U.S. was like, okay, we'll cut them some slack. Basically, we'll let them protect certain industries. We'll let them have government subsidies in those industries because we want to develop them as a trading partner. Well, that's worked out so well that now we are in a trade war. Industrial policy, which isn't just tariffs, it's also preferential treatment, it's limitations on certain key materials, it's requirements for, foreign and direct investment to justify presence in a location. It's been around for a long time, but now it's gaining a whole bunch of traction in the United States. That's the most important difference, is the concept of global free trade, which we championed ever since the Second World War ended. We're no longer championing that. We're like, okay, we're all playing the industrial policy game. Let's see who can make what happen in semicon, in critical minerals, in steel, in, footwear, you name it. So yeah, that is the megatrend, Bob. You're totally right.
Wow. Well, Kevin, thank you so much for those insights. Really interesting discussion. Can I take a moment, though, to ask you about 0100? Who are you guys?
Yeah, 0100, it's a data and research business for chief supply chain officers and chief operating officers who are digitizing supply chain. The name 0100 comes from the concept 0% carbon, 100% digital. As we digitize, and in particular for CSCOs and COOs, you want to make big bets as fast as possible while de-risking the uncertainty in what we know is a fast-shifting environment of AI tech trends and regulatory shifts and robotics that's changing, all of this stuff. We try to make it less risky for you so you can move more quickly in that direction.
Kevin, thanks again for being with me today. Really appreciate it.
Thank you, Bob. Pleasure to be here.
I am speaking with Kevin O'Mara of 0100. Thank you very much for watching.